The Indian economy is in danger. The markets are down. You might be seeing many headlines and opinions that claim this, but is it really the case? And if so, how bad is it? The government has reduced taxes. The RBI has also cut interest rates, but despite that, the Nifty 50 is down 10%. So what's wrong? Welcome to Personal Finance TV. I'm Aaditya Iyengar, CFA, and today we'll break down some data across multiple aspects of the economy and understand if we really are in trouble. In February 2025, our finance minister came out with a huge tax relief for the middle class.
That there will be no income tax payable up to income of 12 lakh rupees.
The slab revisions also led to nearly 1 lakh plus in tax savings for people making above 25 lakh rupees. So naturally, everyone expected the stock markets to react positively and go up. Obviously, because this happened in the previous instances of tax relief during the budget. But despite that, the Nifty 50 is almost 10% down and continues to go down further. Now, to understand why this is happening, we need to take a look at a few numbers and analyze how they are connected to each other. For starters, Donald Trump is at it again. He's imposed back-to-back tariffs on imports from 3 nations, 25% on Mexico and Canada and 10% on China. And now there's obviously uncertainty on what happens with us. And man, it's scary because he has talked about reciprocity, meaning the US will levy import duties on Indian goods exactly equal to what India levies on American goods. And Donald Trump's statement on India isn't any less concerning. He said, in terms of tariffs, our allies are worse than our enemies. While we apply a 2.4% tariff on Indian motorcycles, India applies a 100% tariff on American motorcycles. And that's exactly why Harley-Davidson was forced to build a plant in India. Now, before you panic, this doesn't mean we are in absolute danger. There's a lot of stuff hidden in the details. For context, the US imposes an average tariff of 3% on Indian goods, while India imposes an average tariff of 9.5%, which is almost 3x. But despite that, nearly 75% of all US exports to India attract less than 5% tariffs. Meaning it's primarily because of the outliers like motorcycles, which attract 100% tariffs, that the average gets pulled upwards. So it's likely not the case that we'll see something terrible. However, according to this US government memo, Trump may still use India's GST regime to justify higher tariffs, as that too indirectly costs US businesses. And this would obviously be a bad thing because the incomes, dynamics and growth between India and US are very different. India is a developing nation whose businesses may find these tariffs very hard to deal with. Plus, Indian tariffs going down could also mean huge loss of revenue for the government. As a result, foreign investors are scared, and due to this uncertainty, there is rampant selling in the Indian markets as of now. When FIIs sell, they exit their INR positions and convert their cash into their home currencies. And what happens then? The rupee depreciates. And to add fuel to this fire of depreciation, India operates in a trade deficit, meaning we import more than we export. And as a result, the demand for the US dollar is at an all-time high. And because of this, the dollar has appreciated nearly 6% over the past 1 year alone. And the depreciation of the rupee is expected for the upcoming months because at this time, the RBI wouldn't help the rupee stay afloat. And I'll tell you why. Back when Shaktikant Das Sir was the RBI governor, they would often intervene and use open market operations to ease this depreciation. But under the leadership of Sanjay Malhotra Sir, the RBI is focused on minimum intervention unless absolutely necessary. These tariffs coupled with this depreciation would only make things worse for our importers in the country. And let me make one more thing clear. It's not just uncertainty in India. The uncertainty in the world is so high that something very weird is happening in the US markets. Despite the US Fed cutting interest rates, the US Treasury yield, meaning the rate at which the US government borrows money, is up. This yield is usually down after the first rate cut. And along with this, on the side, the US stock market is up by almost 12% over the last 6 months. Now, according to JP Morgan, this behavior is purely due to heightened uncertainty. But wait, does this mean we are in danger? I haven't answered that question yet. Are we at a risk of a recession? Let's take a look at some more data. But before that, if you learned something new up until this point, consider leaving a like and subscribing to Personal Finance TV. According to a macroeconomic report published by One Finance, India was experiencing a slowdown. But of late, our services sector has picked up, which has offset the slowdown in manufacturing. And there is a chance that India could enter a recovery phase. Now, this report uses a proprietary framework of economic indicators to arrive at a prediction for whether our economy will enter a recovery phase or not. And that figure came out to 60%. And if you look at at the past data, the GDP growth prediction success rate for this report was around 84%. On the other hand, manufacturing companies' debt has now reached historic lows and their manufacturing capacity utilization is also above 70% on average since 2021. On the other end, banks are also posting healthier numbers as their non-performing assets have dropped to newer lows. While we heard headlines of really bad food inflation a few months ago, hitting an all-time high of nearly 11.6%, it's a relief to see that it has eased to 6% in Jan 2025. During this period, our overall inflation also came to a 5-month low of 4.31%, which increases the probability of RBI's rate cuts to stimulate the economy further. Now, all this data does have some evidence that we are headed towards a recovery and not a recession. So the question begs to be asked, what can you do in such a situation? Ideally, given the volatile times, you could look at diversifying into both gold and US equities while also keeping an eye on interest rates to make the most of any home loan refinancing opportunities. The bond market in India could also benefit if RBI does follow through with a series of rate cuts like the one we just had. And of course, balancing between large caps and mid caps will be critical because of the huge valuation difference between the two. If you look at Nifty 50, the price to earnings ratio has averaged around 22 times, whereas the Nifty Mid Cap 100 has had a 1-year median PE of 43x. What do you think though? Are we in a recovery or are there still difficult times ahead? Comment your thoughts below, and if you learned something new, leave a like and subscribe to Personal Finance TV. I'll see you in the next one.